In recent years, much attention has understandably been focused on the exploding national debt in the USA. Interest payments alone are now among the country's largest government expenditures, and it looks like the situation will only get worse. New laws are expected to further widen the deficit between government revenues and expenditures, meaning the debt ratio must rise to compensate for this. Now, the USA is a special economy that at least currently controls the world's reserve currency, so it has more leeway to finance such deficits before getting into too much trouble. But that's not magic either. The US federal government is today the nominally most indebted institution in history, and at some point, someone will have to pay the bill for these debts. Whether it's the next generation of workers through higher taxes, everyone through inflation, or future generations through complete economic collapse. The latter currently seems to be the most popular option. On the other hand, China appears to outwardly embody the opposite of this situation. Its debt is much better controlled at only 84% of GDP, far better than in the USA with 123%, or even Japan with 250%. And on top of that, China is one of the largest buyers of other countries' debt. During the back and forth negotiations between the USA and China, one of the People's Republic of China's biggest hidden weapons was that it owned hundreds of billions of dollars in US debt. The optics were pretty clear. The USA is the borrower taking on more and more debt, and China is the lender saving for the future. However, that's not quite right. A little research shows that China probably has even more debt than the USA, and depending on which numbers you believe, the debt could even be more than 3 times as high. But all of this must be seen in a larger context, because China is a country with a completely different government, a different private sector, and a different overall economy. So how bad is China's debt really? How do they want to use their own loans as an economic weapon? And finally, if debt is just debt, why is it treated so differently by economists? The complexity of Chinese debt structure. One of the biggest differences between China's debt and that of the USA is who actually takes out the loans. In China, the debt is much better hidden and distributed across multiple government levels, state-owned enterprises, and special institutions that exist only to hide debt in the books. In the USA, of course, the federal government is responsible for most public borrowing, but the country also has states and local governments that also take on their own debt. The difference is that in the USA, all regional government debt together amounts to about 12% of GDP, which means that the country, including federal debt, has a national debt of about 132% of GDP. Not great, but not necessarily terrible when you consider the status of the US dollar as the world's reserve currency. In China, provincial governments have much more leeway and a much greater incentive to take on debt to finance large projects. Again, reliable figures are somewhat harder to determine, since the country doesn't have the same standards for information disclosure. But conservatively estimated, the debt of provincial and local governments in China amounted to at least $12.6 trillion in 2023. That corresponds to about 76% of the country's total output, which means that the total debt of the Chinese government is now about 160% of its GDP, roughly 30% higher than that of the USA. State-owned enterprises, the hidden debt mountain. The situation becomes more complicated when we consider that state-owned enterprises are not yet included in this calculation, which fulfill a kind of dual function in China. They are on one hand private companies that want to make profits, and on the other hand, government agencies that must implement the goals set by the party. China State Construction and Engineering Corporation, for example, is the world's largest construction company with revenues of over $320 billion. While it makes a profit, it belongs to the central government, which means 2 things. First, it builds what the government wants, from small local infrastructure projects to the multi-billion-dollar Beijing airport. These strategic developments also extend beyond national borders. China State Construction and Engineering is involved in dozens of major construction projects with partner states, including building a completely new capital in Egypt. These projects serve national interests but are technically not carried out or financed by the government itself. Instead, these companies simply borrow the money so the government doesn't have to. It's almost impossible to know exactly how high these companies' debts are because we don't even know how many of them there are. A Stanford University study found that there are at least 391,000 fully state-owned enterprises in China, ranging from small local construction companies to international banks. Furthermore, there are more than 1 million companies throughout the economy that are owned by the state to some degree. These state-owned enterprises are all highly indebted and have conservatively estimated debts of $30 trillion. When these companies become insolvent, the government faces the choice of either losing these companies that carry out their contracts or stepping in to save them. Either way, this means that the Chinese government's debt, when adding up all the instruments it uses to provide services in the Chinese economy, amounts to over 300% of its GDP, the GDP problem. And it gets worse. All of this assumes that the Chinese GDP figures used as the denominator here are actually reliable, and that's questionable at best. Many economists doubt the official figures, and independent studies suggest that routine inaccuracies in reporting mean that the Chinese economy could be between 20 and 60% smaller than officially stated. This would mean that these debt figures could conservatively amount to up to 450% of GDP, 3 times as high as in the USA. Credit rating and interest rate paradox. Although China is a huge economic power like the USA, it still doesn't quite have the same creditworthiness. Much attention has been paid to the downgrading of US debt from AAA to A+ by most rating agencies, which is due to a combination of persistently high borrowing, lower tax revenues than recommended, and the game of fire they play every few months with their debt ceiling. China, on the other hand, doesn't have an A-, AA+-, AA, or AA US rating, but only an A+. While that's still okay, it means that most agencies see risks here, which in turn means that China should have to pay higher interest rates for all the debt it has accumulated, but it doesn't. At the time of making this video, the yield on a 10-year US government bond is about 4.5%. The yield on a comparable Chinese 10-year bond is only about 1.7%, almost 3 times lower. What's going on here? Why on earth would anyone lend more money to the comparatively riskier Chinese government when they could instead achieve 3 times the return with a US government bond? Capital controls and market restrictions. This assumes that the Chinese economy functions like a normal free market economy, which is particularly not the case with macroeconomic instruments like these. The first difference is that many people and institutions with a lot of money in China cannot buy US government bonds. China has strict capital controls for money leaving the country. This means that even if investors wanted to buy US bonds instead, this wouldn't be an option for them. This even applies to large institutions like banks, which, as mentioned, are also largely state-owned. So yes, when the Chinese government wants to borrow money, it doesn't have to compete with all other countries in the world that are also trying to borrow money. Additionally, there aren't as many other options as outside China. The underperforming stock market. When bond yields are low in a normal economy like the USA, this motivates investors to put their money into other assets like stocks, real estate, or alternative investments where they can achieve better returns. This is one of the reasons why lowering interest rates normally leads to rising stock prices. However, in China, investors don't really have the same options. Economists will always say that the stock market is not the economy, and this is normally used to explain why market returns consistently outperform general economic growth. But in China, it's exactly the opposite. Although the country has experienced the most intensive economic development in history, the stock market has risen by less than 100% since 2000. That might not sound bad now, but in comparison, the US market has achieved returns of over 300%, and we haven't chosen an unfavorable time frame here. In the last 10 years alone, the US market has risen by more than 150%, while the Chinese market was even declining. This means that the stock market doesn't represent a really good alternative, even for bonds with really low yields. Many of the companies listed on these markets are partially or majority state-owned, which means that distributing profits to their shareholders is only a secondary goal, while fulfilling the government's desired functions takes priority. Real estate. The only investment option. Chinese real estate is the world's largest asset class. The country has put its wealth as the world's workshop directly into real estate speculation, and that has caused a lot of problems. We generally consider apartments in a city unaffordable when average housing costs are more than 5 times the average income. In Los Angeles, for example, it's about 7.5 times, in Sydney 13 times, and in London 19 times the average income. In Beijing, this value is almost 35 times. The cities are now as expensive as the major global centers in the West, but average incomes still lag far behind. With an impressive savings rate and no other investment opportunities for their money, real estate has not only made the transition from a form of housing to an asset class, but it has actually become the only asset class. The deflation problem. This has caused the country to slowly build up a lot of household debt, mainly used for increasingly unreachable real estate purchases. A real estate crisis in itself is not a pleasant thing. And the danger that this literal house of cards will collapse is very real in China. But this has also caused another interesting problem: deflation. Real estate prices have risen, but since people desperately save everything they earn to be able to afford these houses or apartments, prices for general consumer goods in China have remained more or less unchanged over the last 25 years. The country is really good at making things, but also really bad at buying them, so supply exceeds demand, making deflation the logical consequence. This may sound like a good problem, but it's not. Stagnating prices slow down the economy because they remove the incentive to spend and invest. Money printing and inflation. We all love the memes about money printing machines, but between 2000 and the end of 2019, the M2 money supply in the USA roughly tripled. Of course, it got a bit heated after COVID, and economists slightly redefined this metric, hence the big increase. In comparison, the money supply in China has even increased 16-fold, which means that the money supply in China has grown 4 times faster than the money supply in the USA. This is because when China wants to borrow money, it simply gets one of its state-owned banks to conjure up some money out of thin air and lend it to the government or state-owned enterprises that need it. Admittedly, the USA and most other advanced economies do exactly the same thing, but not to the same extent. The asset advantage. If we look at debt on a personal level, we normally consider 2 metrics: debt-to-income ratio, which roughly corresponds to debt-to-GDP ratio, and debt-to-assets ratio. Someone with $1 million in debt and very low income seems to be in trouble, but if they have $5 million in assets, then they probably won't have problems. The reason we don't normally consider this for governments is that in recent decades, they generally haven't had as much wealth compared to private households. But China is different. The government officially owns all the land in China and leases it in decade-long lease agreements. But even considering the already leased areas, the land is still worth a lot, especially near economic centers. In addition, all these state-owned enterprises have some value and are very liquid. Many of them are already listed on the stock exchange with a small portion of their shares, so the government already has an instrument to sell these if it ever deems it necessary. Numbers that are somewhat questionable. The only other figures we can rely on here come from the Bank for International Settlements, which estimated net worth at about $20 trillion. But that was in 2014, and of course much could have changed since then. Conclusion: a different economic system. Either way, and regardless of the exact number, it's clear that while China's debt ratio looks catastrophic, its net worth is much healthier than that of most of its competitors. This also means that these debts can be repaid much more easily. But there's probably another important insight from all this. The Chinese economy is incredibly strange. We compared the numbers with those of the USA because that's most logical, but in reality, the whole thing just works differently. The USA has an underregulated private sector where a bit too much capital is being shuffled around, while China is overregulated and the government heavily restricts most natural developments. The USA consumes too much, China too little. The USA has problems with persistent inflation, China with deflation. According to estimates by the Chinese Academy of Social Sciences, the government in China has a positive net worth of about $40 trillion. For comparisons, it's difficult to accurately value all these assets even in the best case, and government agencies have some incentive to produce. And yes, when it comes to debt, the situation is not as opposite as it seems at first glance. China does buy a lot of US debt, but it also has a lot of its own debt that it buys from itself. A real break between these two economies would have no winners and losers, only losers. It's easy to look at current global events and conclude that now is China's time because the USA is making so many mistakes. But that's also unfair because China has just as many, if not more problems than the USA. They're just much better at keeping these to themselves.